This is a bullish divergence as indicated by this indicator. This basically means that the price is most likely gonna go up. If we were to take a long position here, the trade would have been profitable. On the other hand, the same indicator indicated a bearish divergence, meaning there is a high probability that the price will go down. If we were to take a short position here, as you can see, the trade would have been profitable. This is the Turbo Oscillator by Runrocks. In this video, we're gonna go over what this indicator is and how you can use it to trade based on divergences. If you find value in this video, remember to leave a like. Let's get into it. Now, to add this indicator to your chart, you want to go to TradingView, the trading platform that I'm going to be using. If you haven't signed up yet, there's going to be a link in the video description for you to do that. Next, you want to load the 30-minute time frame of GBP JPY. But do not be worried, this strategy can actually be used on any trading security and on any time frame. After that, you want to click on Indicators and type in Turbo Oscillator. And it's going to be this one by Runrocks. The Turbo Oscillator is a technical indicator designed as a comprehensive toolkit that combines multiple analysis techniques into one. Its main goal is to help traders identify trend changes and potential reversal points in real time by leveraging divergences, momentum or volume signals, and other advanced features. One of the core functions of this indicator is divergence detection in real time. It identifies both classic divergences and hidden divergences as soon as they occur. A classic divergence occurs when the price action and the oscillator move in opposite directions. For example, for a bullish divergence, the price makes a new low, while the oscillator fails to make a new low and instead makes a new high. For a bearish divergence, the price makes a new high while the oscillator does not make a new high, but instead makes a new low. The Turbo Oscillator is going to highlight these discrepancies in real time to indicate potential reversal points. Now, how about hidden divergences? Well, hidden divergences are the opposite of classical divergences. Looking at these two images, you can see that a hidden divergence is basically the opposite of a classic divergence. Now, let's go over what this indicator is made of. The first component we can see is obviously the classic divergence line, which are these white lines. Whenever they're printed, they indicate either bullish or bearish divergences. The lines at the bottom of the oscillator indicate bullish divergences, meaning the price might go up. The lines at the top of the oscillator indicate bearish divergences. We also have hidden divergences, but for that, you gotta activate them in the settings. You just double-click on the indicator, and then you activate the hidden divergences. And as you can see, they're gonna have two colors. Green lines at the bottom indicate bullish hidden divergences. Red lines at the top indicate bearish hidden divergences. The next component is called the signal line. It provides insights into trend changes and price reversals. These dots on the line indicate the beginning of a trend shift. They can vary in size, offering a clearer understanding of the strength of the emerging trend. This feature works in combination with the RSI, the stochastic, and the MFI indicators, ensuring you capture every market movement accurately and promptly. The indicator also has the money flow histogram, this one right here. It uses an extended period, providing a more comprehensive and accurate analysis of market conditions. The money flow histogram can also be used as an additional confluence through divergences. So when you spot a divergence happening on the signal line as well as on the money flow, it's a stronger indication that the market might shift. Next, we have these arrows at the top and bottom of the oversold and overbought levels. And you might be thinking, what exactly are they? Well, these are called predicted reversal zones. In cases of strong overbought or oversold conditions, the indicator detects potential price pullbacks and marks the beginning of a trend change. This helps better identify trend shifts. These reversal zones can actually be used as potential take profit points for your trades. Now, let's take a look at this indicator settings and see how customizable it can be. First of all, we have an option that allows you to enable or disable the signal line, giving you control over whether you want to display it on your chart. And then we have the length, which defines the look-back period for calculating the signal line's momentum reading. Here we have smoothing. This applies a smoothing to the signal line, helping reduce noise and making the trend changes clearer and clearer. Here we can decide to show or hide the histogram, the money flow histogram, on the chart. I'm gonna hide it because I'm not gonna be using it. The show status line shows a small label indicating whether the oscillator is currently overbought or oversold, and it's going to enable the reversal signals. And we have other options as well. The style tab has a few toggles that you can turn on or off. After you've made your changes, click OK. Now, using this indicator to trade is as simple as this. Obviously, this is a super simplistic strategy just to showcase how this indicator works. The basic idea is to combine divergences with overbought or oversold conditions as well as reversal signals for stronger confirmations. If you didn't already know, a market is considered overbought or oversold when these levels shift from gray to a bright red for oversold or a bright green for overbought. These arrows indicate potential reversals, and when they appear alongside divergences, it strengthens the signal. Now, for a long position, condition number 1 is to identify a bullish divergence, which, as you can see, it's right here. The price created a lower low, while the oscillator created a higher low. Condition number 2 is that the market should be extremely oversold, and that is going to be indicated by the bright red color on the oversold level. Condition number 3 is that you want to have a bullish reversal signal either aligned directly below the divergence or in between the divergence and the tiny dot at the end of the signal line. To illustrate this even better, if I place a vertical line exactly on the divergence dot and then another line at the tiny dot at the end of the signal line, the green arrow should appear on this line or somewhere in between. If the arrow is printed before the divergence, the signal becomes invalid. As you can see, it's now aligned with the divergence here, so our condition is met. Keep in mind, these divergences are delayed by 2 candles, so you can't just enter the trade on the exact signal candle. If you were to use a bar replay, you'll see the divergence is only printed after the signal line shifts from red to green, and a trend shift signal, which is a tiny dot like this one, is printed at the end of the signal line. Once these conditions are met, you take your long position. Place your stop loss comfortably below the most recent swing low, so it has enough room. Since this is a reversal type entry, you can go for a larger take profit, such as 2.5 times the risk, letting the trade run. And as you can see, it was profitable. Now, let's take a look at another long position. If we just take a general look, you can see we had the divergence here, meeting our first condition. Looking at the bottom, you can see the oversold level indicator is bright red, meaning that during the divergence, the market was oversold. Now, just like I mentioned before, your last condition is to check in between the divergence dot and the end of the signal line. You want to see an upward reversal signal, either exactly on the divergence itself or somewhere between these 2 points. Right here we can see the bullish reversal signal appears in between the divergence and the end of the signal line, which meets our condition. If it had appeared to the left of the divergence, the entry would become invalid. The goal is to have the divergence established first, and then the reversal signal is printed either at the end of the divergence or immediately after. Looking at this trade, you can see it was profitable. Now, for a short position, it's going to be the opposite. Condition number 1. Check that we have a bearish divergence. Here is our bearish divergence. Price established a higher high between this high and this high, while the oscillator established a lower high. Condition number 2. Check if the market is overbought immediately after the divergence, indicated by a bright green color on the overbought level, which, as you can see, we have it here. And then you want to look between the end of the signal line and the dot marking the end of the divergence label. Either exactly on this dot or in between here and here, there should be a red bearish reversal signal. Right now, as you can see, it's in between, which makes it valid. We enter short position, place a stop loss above the most recent swing high with some breathing room. The take profit is going to be set at 2.5 times the risk, letting the trade run. And as you can see, ladies and gentlemen, the trade was profitable. By understanding all the components of this indicator, from divergences and the signal line cues to volume histograms, traders can fully harness the Turbo Oscillator. It's a feature-packed indicator aimed at giving you early signals for trend changes and guiding trade entries and exits. Remember, this video is not financial advice and this strategy is not foolproof. Do your own backtesting and forward testing to see what works and what doesn't. If you found value in this video, remember to leave a like or even consider subscribing to stay tuned. Thanks for watching. See you next time.